Something happened this week that will affect the income of every single pensioner in the United Kingdom, and the majority of retirees have not yet worked out what it means for them personally. The Bank of England has held its base rate at 3.75%. That one decision, made by a small group of people in a building in the City of London, has immediate and real consequences for your state pension, your savings, your annuity, and your retirement income. But here is what most people are not being told. The impact of this decision is not the same for every pensioner. For some, holding the rate at 3.75% is genuinely good news. For others, it is the beginning of a problem they have not yet noticed. And for a third group, and this is the group we are most concerned about today, the real risk is not what the rate is doing right now. The real risk is what happens next. Because the Bank of England does not hold rates forever. And when rates eventually move, whether up or down, the effect on pension income, savings interest, annuity values, and mortgage costs for older borrowers can be significant and swift. Most pensioners never realize how directly the Bank of England's decisions affect their day-to-day finances. They hear the announcement on the news, they think it is something for banks and businesses, and they move on. But by the end of this video, you will understand exactly what a rate hold at 3.75% means for your retirement, and what you should be doing about it right now. Stay with us. The section towards the end of this video covering practical steps is the part that could make the biggest difference to your financial position this year. To understand why today's decision matters so much in 2026, we need to go back a few years and look at where we have come from. In 2021, the Bank of England base rate was just 0.1%. Savings accounts were paying almost nothing. Fixed-rate bonds offered virtually no return. And pensioners with cash savings were watching the real value of their money quietly erode due to inflation. Then inflation surged. The Bank of England responded by raising interest rates aggressively, one of the fastest cycles of rate increases the UK had seen in decades. By the time rates peaked, the base rate had reached 5.25%. For pensioners with savings, that was genuinely welcome news after years of near-zero returns. Savings accounts began paying meaningful interest again. Fixed-rate bonds offered rates that pensioners had not seen since before the financial crisis. But then the Bank of England began cutting rates. And now, in 2026, the base rate sits at 3.75%, held at this level as the bank continues to assess the state of the economy, inflation, and growth. Here is why that matters so much right now. We are at a turning point. The rate has come down significantly from its peak. It has not yet fallen to the very low levels that caused so much damage to savings income between 2009 and 2021. But the direction of travel has been downward, and every time the Bank of England cuts rates, or even signals that cuts are coming, it has a chain reaction through the entire retirement finance landscape. Savings rates fall. Annuity providers adjust their offerings. Pension fund valuations shift. And pensioners who have built their retirement income plans around a certain level of interest or return suddenly find those plans are based on numbers that no longer exist. This is the big problem. Not just the rate today, but what the rate is telling us about the direction of the next 12 to 24 months. And the important detail comes later, because not all retirement income is affected in the same way, and understanding which parts of your income are at risk is the first step to protecting yourself. The real issue is not what most people think. When pensioners hear that the Bank of England has held rates at 3.75%, the natural reaction is relief. Rates have not gone down again. Savings accounts are still paying a reasonable return. Things are stable. And to some extent, that reaction is understandable, but it misses something important. The hidden truth is that by the time the Bank of England officially changes the rate, most of the impact has already happened. Banks and building societies do not wait for the Bank of England to act before they adjust their savings rates. They anticipate. They read the signals. And when financial markets begin to price in future rate cuts, which they have been doing for much of 2025 and into 2026, high street banks begin quietly reducing the rates they offer on new savings products. This means that pensioners who are looking to open a new savings account, renew a fixed-rate bond, or move their money to a better rate are already finding that the best deals available today are noticeably lower than what was available 12 months ago. Most pensioners never realize this is happening until they go to renew a fixed-rate bond and discover the new rate is significantly lower than the one they were receiving. That moment of renewal, when a pensioner's fixed-rate bond matures and they look for a replacement, is where many retirees get caught out. They have been receiving, say, 4.5% on a one-year bond. They go to renew it, and the best rate available is now 3% or lower. On a savings pot of £40,000, that difference is not trivial. At 4.5%, the annual interest is £1,800. At 3%, it falls to £1,200. That is a reduction in income of £600 per year, simply because of where interest rates are heading. For a pensioner living on a fixed income, £600 per year is a meaningful sum. And this is happening quietly, without any letter from HMRC, without any announcement from the DWP, and without any notification from the bank beyond a standard renewal notice. Understanding this now, before your bond matures, before your savings rate resets, gives you the opportunity to act. And that is exactly what we are going to cover. Dorothy receives the full new state pension and a small defined contribution pension pot that she has not yet drawn on. She has £45,000 in a fixed-rate cash bond that she took out 18 months ago at 4.8% interest. That bond matures in 3 months. When Dorothy took it out, she assumed she would simply renew it at a similar rate. But the best available rate for a one-year fixed bond today is around 3.2%. Her annual interest income will fall from £2,160 to £1,440, a reduction of £720 per year. Dorothy has not budgeted for this. She was using that interest income to cover her quarterly energy bills and a small contribution to her grandchildren's savings. She needs to act now, before the bond matures, to explore her options and decide whether to lock into a new rate, consider a longer-term bond, or look at alternative savings vehicles. Kenneth retired 2 years ago and chose to purchase a lifetime annuity with his pension pot of £120,000. He receives a fixed annual income from that annuity for the rest of his life. When interest rates were higher, annuity rates were also at their best levels in over a decade. Kenneth's timing was fortunate. He locked in a strong rate, and his income is guaranteed regardless of what happens to interest rates now. For Kenneth, the Bank of England holding rates at 3.75% changes nothing about his day-to-day income. His annuity is fixed, but Kenneth's neighbor, who is 67 and still has his pension pot invested, is now watching the annuity rates available to him fall as rates come down. If he waits another year before purchasing an annuity and rates fall further, the income he can buy with his pot may be noticeably lower than it is today. This is one of the most significant and underappreciated risks for pensioners who have not yet converted their pension savings into income. Margaret and Ronald are a retired couple who own their home and have around £90,000 in various savings accounts between them. They have been benefiting from higher interest rates and have been receiving a combined savings income of around £3,800 per year. But they have also been watching with concern as their savings rates have been quietly reduced on their easy access accounts. One account that was paying 4.1% 6 months ago is now paying 3.4%. Another has dropped from 3.8% to 3.1%. No dramatic announcement was made. The bank simply sent a short letter with the new rate. Margaret and Ronald need to review all of their accounts, compare current rates across the market, and consider whether moving some savings to fixed-rate products would lock in a better return before rates fall further. They also need to be aware of the personal savings allowance, because at their combined savings level, the interest they are receiving may be pushing them into a taxable position. Sylvia took early retirement at 63 and has been living primarily on her savings while waiting to reach state pension age, which she has now done. She has a smaller savings pot than she would have liked, around £22,000, because she has been drawing on it for 3 years. She was relieved when interest rates rose because the returns on her savings helped slow the depletion of her pot. Now she is concerned about what happens as rates come down. Her savings are earning less. Her state pension, while welcome, does not fully cover her monthly outgoings. She is wondering whether she qualifies for pension credit, which could top up her income significantly. Sylvia's situation highlights something important. For pensioners with modest savings and income below a certain threshold, falling interest rates make it even more important to check whether means-tested benefits like pension credit are available. Savings income that has fallen means total income may also have fallen, which can affect benefit eligibility in ways that could actually be to a pensioner's advantage. Geoffrey has a defined benefit pension from his former employer, a final salary scheme, which pays him a fixed income that is adjusted for inflation each year. He also has £30,000 in savings. For Geoffrey, the Bank of England's rate decision has a relatively limited direct impact on his main pension income, which is not linked to interest rates. But he has a small, outstanding balance on a retirement interest-only mortgage he took out to fund home repairs 3 years ago. The rate on that mortgage is variable and linked to the Bank of England base rate. When rates were rising, his monthly mortgage payments increased. Now that rates have been held and may fall further, Geoffrey may see his mortgage costs reduce slightly over the coming months. For him, lower rates in the future would be a modest but genuine benefit. This example shows that the impact of Bank of England decisions is never the same for every pensioner. It depends entirely on your personal financial situation, what type of pension you have, whether you have savings, and whether you have any debts. The Bank of England's Monetary Policy Committee, the group that sets the base rate, meets 8 times a year to review the rate. Their primary objective is to keep inflation close to the government's target of 2%. When inflation is high, they raise rates to slow spending and borrowing. When inflation is under control and the economy needs support, they lower rates to encourage growth. The decision to hold rates at 3.75% in 2026 reflects the bank's judgment that inflation is close enough to target to stop raising rates, but that the economic outlook is uncertain enough that they do not yet want to cut further. For pensioners, this matters because it sits in the middle, not the disaster of near-zero rates, but not the higher returns of the peak rate period either. Financial institutions, banks, building societies, annuity providers, all price their products based on where they expect rates to go, not just where they are today. That is why savings rates and annuity rates can fall before the Bank of England has officially moved. The DWP is also relevant here because the state pension is uprated each year under the triple lock, rising by the highest of inflation, average earnings growth, or 2.5%. The interest rate environment affects inflation, which in turn affects how much the state pension rises. In a lower rate environment, inflation typically eases, which may mean future state pension increases are driven more by earnings growth than by inflation, something worth monitoring each year. All of this connects. The Bank of England rate is not just a number on a news broadcast, it is the foundation on which much of UK retirement finance is built. There are clear steps you can take right now to protect your retirement income in a 3.75% rate environment, where further cuts remain possible. The first step is to review every savings account you hold and check the current interest rate being applied. Easy access accounts in particular tend to have their rates cut quietly and frequently. Compare your current rate against the best available rates on the market. The Money Saving Expert website and comparison tools like Money Supermarket can show you the best current rates without any obligation. If your rate has fallen significantly, moving savings to a better-paying account or locking into a fixed-rate bond now, before rates potentially fall further, could protect your savings income for the next 1 to 2 years. The second step is to think carefully about fixed-rate versus easy-access savings. In a falling rate environment, locking money into a fixed-rate bond means your rate is guaranteed for the term of the bond, even if the Bank of England cuts rates further during that period. The risk is that you cannot easily access the money during the fixed term without penalties. Consider how much of your savings you genuinely need to keep accessible for emergencies, and whether a portion could be fixed for a better return. The third step, if you have a pension pot you have not yet converted into income, is to seek professional guidance before making any decisions. Annuity rates are linked to interest rates and to government bond yields. Depending on your circumstances, the rates available today may be better than those available in 1 or 2 years if the Bank of England continues to cut. This is not a decision to make lightly, and it is important to take independent financial advice before committing to any annuity or income drawdown arrangement. The fourth step is to check your pension credit eligibility. If your total income, from the state pension, savings interest, and any other source, is below the pension credit threshold, you may be entitled to a top-up payment from the government. As savings interest falls in line with lower rates, some pensioners who were previously just above the threshold may now fall below it. Checking eligibility costs nothing and can be done on the government's website or by calling the pension credit claim line. The fifth step is to review your overall retirement income plan with fresh eyes. If your plan was built when rates were higher, it may need adjusting. Consider whether your current level of savings income is sustainable, whether you are making full use of your ISA allowance, and whether there are any benefits or entitlements you are not currently claiming. If you have already noticed that your savings income has fallen, or that your fixed-rate bond has matured and the replacement rate is significantly lower than before, please do not panic. This is a situation that many pensioners across the UK are currently navigating. The first thing to do is work out exactly how much your income has changed and whether that change affects your ability to meet your regular outgoings. Put the numbers on paper, know your new monthly savings income, and compare it to what you were receiving before. If there is a shortfall, the next step is to identify whether there are any immediate adjustments you can make, switching to a better savings rate, reducing a non-essential expense, or accessing a benefit you were not previously claiming. If the change in income is significant and you are concerned about covering essential costs, contact Citizens Advice or your local council's welfare rights team. They can carry out a full benefit check and identify any entitlements you may be missing. Age UK also offers a free helpline and benefit check service specifically for older people. If you are worried about your pension pot or your long-term retirement income plan, speaking to a registered independent financial advisor is worth considering. Many advisors offer an initial consultation at no cost, and depending on your circumstances, advice can make a very significant difference to your financial position over the long term. The most important thing is not to make rushed decisions. Do not move large sums of money in a panic. Do not lock into a financial product without understanding the terms. Take your time, gather information, and get guidance where you need it. The Bank of England's decision to hold rates at 3.75% is not just a story for financial markets and economists. It is a story that touches the savings, the pension income, and the day-to-day finances of every retired person in the United Kingdom. The core lesson of everything we have covered today is this: we are in a period of transition. Rates have come down from their peak and may come down further. The savings income and bond rates that many pensioners have been relying on over the past couple of years may not be available at the same levels going forward. Acting now, Reviewing your savings, understanding your options, checking your benefit entitlements, and planning for a lower-rate environment is far better than waiting until the impact has already been felt. Most pensioners who struggle financially in retirement do so not because they made dramatic mistakes, but because they did not notice small changes happening gradually around them. The Bank of England rate is one of those changes. It moves slowly, but over months and years, its direction shapes everything from your savings interest to your state pension increase to the annuity income you can buy with your pension pot. Now you understand it. And that understanding is genuinely valuable. If this video has been helpful, please consider subscribing to Retirement Money UK. We publish regular updates on everything that matters to UK pensioners and retirees. State pension changes, DWP benefit updates, HMRC guidance, pension credit, savings rates, and all areas of retirement finance. Everything we cover is explained clearly and calmly, designed for people in or approaching retirement who want to understand their finances without jargon or confusion. Thank you very much for watching, and we will see you in the next video.